In 1965, the average American CEO earned about 20 times what their average worker made. Today it's roughly 300 times. In the 1950s, a single factory paycheck bought a house, a car, and a college education. Today, the bottom half of all American households, 65 million families, own about 2.5% of the nation's wealth. The stock market says this is the richest America has ever been. So why does it feel broke? Because we're measuring the wrong thing. In the next 8 minutes, I'm going to give you a better gauge, call it the Wealth Gap Misery Index, and walk you through what it says about every era of the American economy, including the one the artificial intelligence boom is building right now. Economists have an old tool called the Misery Index, unemployment plus inflation. Simple, brutal, useful. In 1980, it hit 22 and helped end a presidency. But it has a blind spot. It measures the temperature of the average economy. It says nothing about who's actually holding the thermometer, because an economy can post record GDP, record profits, and record stock prices while most of the people in it lose ground. To see that, you have to track the ratio, how the pie is split, not just how big it is. So run the eras. Start with the first Gilded Age, the 1890s, railroad and oil fortunes so concentrated that the top 1% held roughly half the nation's wealth. The best job in America was owning things. The floor for everyone else was a 6-day workweek with no safety net. It took antitrust, 2 world wars, and a depression to compress it. Then the anomaly, 1950 to 1973. Strong unions, a third of workers carried a card, high top tax rates, and a booming industrial base produced the flattest wealth distribution in modern American history. The best jobs were everywhere. A line worker in Detroit outturned most of the planet. The floor was a middle-class life on one income. We think of that as normal. Historically, it's the exception, a 20-year blip that an entire country mistook for a birthright. 1980 to 2000, the Great Rewidening. Deregulation, globalization, the collapse of unions to barely 10%, and the tech boom. The best jobs migrated from the factory floor to 2 zip codes, Wall Street and Silicon Valley. A software engineer or an investment banker in 1999 wasn't just doing well, they were pulling away from the median worker at a speed not seen since the robber barons. Meanwhile, the floor quietly dropped. Real wages for production workers barely moved for a generation, even as productivity soared. The pie exploded. The split changed. The average hit it. And today, the Federal Reserve's own data says the top 1% now hold roughly a third of all U.S. wealth, the bottom 50%, that 2.5% sliver. The top 10% own around 90% of all stocks, which means when the market hits a record, 90% of the gains land on 10% of the doors. By share of wealth at the top, we are now at or past 1929 levels. On the classic Misery Index, this economy scores fine. On the Wealth Gap Misery Index, it's flashing a 100-year extreme. Now layer on the newest force, the artificial intelligence capital expenditure boom. Hundreds of billions of dollars a year pouring into data centers, chips, and power, one of the largest private infrastructure buildouts in history. And look at how the jobs split. At the top, AI researchers getting athlete-level pay packages, senior engineers whose equity doubled, electricians and pipefitters in data center counties suddenly commanding overtime they haven't seen in decades. At the bottom, entry-level white-collar work, the first rung of the old ladder, quietly automated or frozen. Junior analysts, paralegals, customer support, basic coding. The historical pattern is repeating with a twist. Every boom picks its winners, but this one may be the first that competes directly with the college-educated starting job. The 1890s gave you owning things. 1999 gave you writing software. The 2020s give you owning the machines, or wiring the buildings they live in. Here's the part that should actually worry you, whichever side of the K you're on. The top 10% of earners now drive roughly half of all consumer spending in America. The whole record-high economy is balanced on the spending of the people who own the assets. That's not a moral observation, it's a structural risk. When prosperity narrows, the economy gets top-heavy. One correction in asset prices and the only engine still running stalls. The 1920s taught that lesson the hard way. Concentration isn't just unfair to the bottom. It's fragile at the top. So what do you actually do with this? 3 things. First, stop using the stock market as a scoreboard for the economy. It's a scoreboard for the people who own it, and you now know how few that is. Second, if you can own assets at all, index funds, a house, anything that compounds, the entire last century says the gap grows through ownership, not wages. The system is telling you loudly which side of the ledger to be on. Third, watch the AI build out the way workers in 1890 should have watched the railroads. The winners won't just be the founders, they'll be everyone positioned near the money. The trades, the suppliers, the towns with the power lines. Booms are maps if you read them early. The American economy isn't one economy anymore. It's a penthouse and a basement sharing an address, and the elevator, the starting job, the affordable house, the pension, is the thing we quietly removed. The average says we've never been richer. The ratio says we've rarely been more divided. Both are true. Only one of them tells you what happens next. If you want more breakdowns where the data does the talking, money, markets, and who actually gets the gains, subscribe and hit the bell because I cover the numbers behind the headlines every week. And tell me in the comments, which economy are you living in, the record high one or the other one? Be honest. The comment section here has been sharper than half the pundits on TV. See you in the next one.